Welcome to The Explainer. Today we are getting into the kitchen of the investment world. We're going to slice into a really big question. When you buy a fund, are you paying for a five-star creation, or are you just paying for a really fancy box?
All right, so let's just jump right in. We're going to start with a problem that, pretty much every new investor runs into. So, you've got some money saved up, right? You're ready to make it grow. But then you look at the thousands of stocks and bonds out there, and it just feels completely overwhelming. I mean, where do you even start? It's exactly this feeling that leads most people to something called pooled funds. Now, to really get what's going on with the two most popular kinds of funds, we're going to use a simple and kind of delicious analogy. Think of it like this. On one hand, you have a unit trust. This is like going to a fancy bakery and hiring a professional baker to make you a custom, one-of-a-kind cake. You're paying for their skill and creativity. On the other hand, you have an ETF, an exchange-traded fund. This is like grabbing a reliable cake mix off the grocery store shelf. It follows a simple, time-tested recipe every single time. So let's talk about that custom cake. A unit trust, you might also hear it called a mutual fund, is all about active management. You have a professional fund manager, a whole team of analysts actually, who are pooling everyone's money together. They're doing all the research, picking and choosing specific stocks and bonds, and trying to make brilliant moves to beat the market. You're hiring that master baker. And then we've got the pre-mixed cake, the ETF. This is the total opposite. It's passively managed. It's not trying to be clever or outsmart anyone. Its only job is to follow a recipe, which is a market index, like the S&P 500. It just aims to be the market, not beat it. So you can see their entire philosophies are just worlds apart. The ETF is passive and wants to match the market, and you can trade it all day long, just like a stock. The unit trust is active. It's trying to beat the market, and you can only buy or sell it once at the end of the day at a set price. For you, the investor, this means the unit trust is a totally hands-off experience, while the ETF gives you a lot more direct control.
Now you can probably guess where this is going. This huge difference in approach? Well, it leads to a really big difference in one area we all care about: what it's gonna cost you.
I mean, it just makes sense, right? A custom cake from a master baker is obviously going to cost more than a box of cake mix from the store. All that professional management, that team of researchers behind a unit trust, yeah, that comes with much, much higher fees.
And we're not talking about just one simple fee here. Oh no, the costs can really pile up. You might get hit with an entry fee or sales charge of up to 5% right off the bat. That means if you invest $10,000, $500 of it is gone before your money even starts working. Then you've got the high annual fees, and sometimes even fees just to switch between funds.
And when you put the annual fees side by side, wow, the difference is just staggering. A unit trust is often charging you 1 to 2.5% every year. Compare that to an ETF where the fee is often way below 1%. That difference is absolutely massive, and it really adds up over time.
And if you think a little 1% difference doesn't matter, well, take a look at this. This is what we call the silent killer of wealth. Over 30 years, that tiny 1% difference in fees could cost you over $80,000 in returns. Fees are like termites, slowly eating away at your financial future.
Okay, so you're paying a huge premium for this custom cake. The million-dollar question is, does it actually taste any better? Does all that expensive active management actually get you better results? You'd think so, right? I mean, it seems perfectly logical. You're paying for an expert, so you should get expert results. You'd expect them to outperform the simple cake mix. But the hard data, well, the data tells a very, very different story.
And there you have it. This is the tough pill to swallow. Study after study confirms that the vast majority of these professional fund managers failed to beat their own targets over the long run, especially once you factor in those high fees we just talked about. So in a lot of cases, you're paying more for the fancy baker, but you end up with a cake that's not even as good as the simple recipe.
And beyond just performance and cost, there's another huge difference: flexibility. ETFs are super liquid. They trade on the stock exchange all day, so you can buy or sell them instantly, whenever the market's open. It's just like grabbing that cake mix off the shelf. But with a unit trust, you put in your order and you have to wait. The trade only happens once, at the end of the day, so it's much slower to react to what's happening in the market.
Okay, so after all of that, we've talked costs, performance, flexibility. How on earth do you decide which of these is the right fit for your own goals?
Look, there is no single right answer for everybody. It really boils down to what you personally care about most as an investor. If low costs and being able to trade whenever you want are at the top of your list, the ETF is probably the clear winner. But if you want someone else to handle everything, you want that professional oversight and a completely set-it-and-forget-it approach, then a unit trust might feel right, even with the higher costs.
So let's just boil it all down. The bottom line is this. Unit trusts are selling you convenience and professional management, but it comes at a very high price, and there's absolutely no guarantee it'll lead to better results. ETFs, on the other hand, give you a low-cost, flexible, and straightforward option that puts you in the driver's seat, happy to just get the market's return.
And in the end, that's the question you have to answer for yourself. Are you looking for that master baker, or are you happy with a trusted recipe? Understanding your own style, what you value, and how hands-on you want to be, that is the absolute key to choosing the right tool to build your wealth.